Welcome to the channel of Finance and Accounting with Asadullah. Today in this video, we will learn what is monetary policy, which is very important for the economy of a country, especially for controlling the money supply within the financial market. We will discuss certain things in this video like financial market, what is financial assets and different things. But the first thing that I would mention here is the title of monetary policy. We will discuss this with detail, as well as central banks of various countries. What is the function of central bank? The one important function of central bank is to control the money supply, and the control is by two methods: contractional monetary policy and expansionary monetary policy. One is contractionary monetary policy and the second is expansionary monetary policy. I'm gonna discuss it with detail. Now I'm showing you central banks of various countries. India, Reserve Bank of India; Austria, European Central Banks; USA, Federal Reserve. So these are the central bank of these countries, like UK, Bank of England; Australia, Reserve Bank of Australia; Argentina, Central Bank of Argentina; Switzerland, Swiss National Bank; Afghanistan, Bank of Afghanistan; South Africa, South African Reserve Bank. Likewise, a lot of countries have their own central banks which control their economy, which have a very good function of money supply, how to control money supply, and they know when to control money supply and how to control money supply. Okay, so this is the list, so you can read and uh, you will have information about these central banks. And the main, one of the function of central bank is to control the money supply in the financial market. Okay. Now we're coming back to the point. What is monetary policy? Monetary policy refers to the steps taken by a country's central bank to control the money supply for economic stability. Monetary policy refers to the steps taken by this country's central bank to control the money supply for economic stability. Why they control money supply? They want economic stability. For economic stability, they control money supply. So who control money supply? Central bank of that country, whatever country it is. So for economic stability, they control money supply. For example, policymakers manipulate money circulation for increasing employment, GDP, price stability by using tools such as interest rate, reserve bonds. How they control money supply to control to increase economic stability? By different ways. Like if they want to increase employment, if they want to increase GDP, if they want to stabilize the prices of the commodities within the country, so they're using different tools: interest rate, reserves, bonds. So, and in next slides, I have discussed with detail that what is the tools of monetary policy, how they implement monetary policy in the country. But before going to start the tools of monetary policy, first of all, we need to understand the types of monetary policy. For example, monetary policy, as I said in the start, that we have a two policies, monetary policies: contractionary monetary policy and expansionary monetary policies. The central bank adopts contractionary monetary policies to control the economic condition like inflation by shrinking the money supply in the financial system. For this purpose, the central bank sells off short-term government securities, hikes borrowing rates, or increases banks' reserve requirements. So, in short, in a nutshell, if I summarize all the story of the contraction policy, the central bank of whatever country it is, if they want to bring stability into the financial market, what they do actually, they sells the short-term government securities uh, to when they sell securities, they pick money from the market, so by this way they can increase the money control. They can control the money, and when they supposed to increase the interest rate, people withdraw the money from businesses, and they prefer to deposit into the banks because they want a high return. In the market there will be no return actually more than the banks offer at the time of the contractional policy, when the state bank when the bank, when the central bank of a country wants to control the money supply. By that way they can increase the interest rate. So this is called contractionary policies. And expansionary monetary policy, and in situation of economic slowdown, the central bank implements various expansionary monetary policy like buying short-term loans, security, government securities, lowering borrowing rates, and decreasing the bank's reserve requirement. The purpose is to uplift the money supply and the economy for enhancing consumer spending and decreasing unemployment. However, it may result in inflation. Now, in Pakistan, it is a high inflation, 47% of inflation. So now the central bank wants to implement contractionary monetary policy. Expansionary monetary policy is the opposite of contractionary monetary policy. And expansionary monetary policy, inflation is high when they implement expansionary monetary policy. So then the inflation hikes to the skies. Inflation is high of the commodities in the market. Now, what are the tools of monetary policy? Open market operation, reserve requirement, interest rate adjustment. These are three tools. Open market operation. The central bank purchases short-term government assets such as US Treasury bonds or federal assets in the open market operation. If the central bank is targeting a recession, it will purchase the securities from the bank offering them. This will increase the bank cash flows and reserves. So this is a very clear statement of an open market operation. Everybody can easily understand. Whoever have a little bit knowledge of finance and accounting. So this is especially for those people who want to study monetary policy. And actually monetary policy is a backbone of the economy, of the money supply. They they oftentimes do changes in monetary policy to control the price stability within the country. Reserve requirement changes the central bank prescribed limit of reserves that the commercial bank needs to maintain from their customer deposits as an essential tool. In the situation of economic expansion, the reserve requirement is increased to decrease the money supply in the system. On the other hand, it is decreased as a part of expansionary policy. What is interest rate adjustment? Central bank changes in an interest for short-term lending to the commercial banks, which is referred to the adjustment in discount rate. The loan helps in meeting reserve requirement in short-term cash flows. If the bank increases the discount rate, it eventually permits to other rates, including those of commercial loans. Thank you for watching this. And in the second video, we are gonna discuss the fiscal policy. These policies can help us to understand the economy of our country easily, or from which country you are. I hope you will be good. And after watching this video, I hope that you would learn a lot of things. Thank you very much.